Welcome, everybody. Thank you for if you're in this time zone or one of the early ones. Thank you for getting up early and joining us. My name is Jeff Mayhem. I will be hosting, and we have a really exciting little session for you today. We're breaking some ground in the training education world of trading, and we're really excited. So, without further ado. Okay, and I apologize. We have a little bit of a system problem at my end. I'm trying to do this across two computers and having a little bit of an issue, so bear with me if there's a problem with that. Anyway, this is me. My name is Jeff Mayhem. There's my contact information. Joining me in just a moment is going to be Lee Harris, and I will let him introduce himself at the time. The material we're going to present to you guys, as always in these kinds of sessions, this is educational. We're not telling you what to do with your money or anything like that. Make your own decisions. We're all adults. But having said that, I think you can learn a lot and you can get yourself on a good financial path with stuff you can learn out there, including this session. So sit back and we'll see what we can do. Our agenda today: who we are, how we got here, and who's this audience. I need to spend a minute on this because there's actually three unique groups here today, and I'm going to introduce that by telling you just 2 seconds on who I am. My name is Jeff. I've been trading since I was 13. I'm almost 60. Also a career in IT, worked for IBM, Microsoft, was involved with over 25 startups in various ways, venture capital, founder, sales manager, salesperson, you name it. And trading has always been my passion. So I started doing, I've done a lot of different kind of educational things and groups and fun things. And I started doing Surfing the Markets, which a number of you have seen. It's my Facebook page, and just started posting things I was doing, and a little community formed, and that's kind of how I got here. And along the way, I met Lee, and Lee is a similar story, has an IT background, and has always been interested in trading and doing it for the last 20 years or so. And we just kind of literally started just chatting, and one day I was posting setups in my Surfing the Market, and I kind of threw this idea out, who would want to learn about this stuff, and a few people did. So we formed a thing we called the workshop, and 55 of us went through the last 3 months what we call a process-driven approach to understanding setups in the financial markets. And so that's one group that's here, the people that came through with me and Surfing the Markets. Lee has invited some of his folks here as well, and these are people that have completely different trading backgrounds and varied ones, and are again serious about their trading activities, and are looking for unique collaboration. So they're joining us as well. And then we just have some guests. I have some high school friends here, for example, just want to learn about our world. So I'm telling you guys all this because I just want you all to understand that we're going to try to make this as free of jargon and as colloquial and easy to understand as we can. And we will be stopping at a Q&A at the end, so you can ask us anything at that point. Okay, so without draying on that too long, Lee, why don't you tell us a little bit about why price moves?
What we're going to cover today is the basics of why price moves. And it's in a high-level view of how we read volume and how we read liquidity. Topics we're going to cover on, in our view, the markets that we're trading, who's doing what and why they're doing it, how can we go about tracking this, what does this mean for us if our trading style is predominantly scalping, or conversely, what if we're more into swing trading? What does the activity mean for us? And then how can we apply this further? Now, this may sound really basic, but I like to take the view that in most things, we've got to understand things from first principles. I mean, trading is complex and it's high risk. We've got many inputs into our decision making, lots of data points that are changing all the time. We've got to make decisions very quickly. And the consequences of getting the decision wrong are high risk. We lose money. And, that's not the plan that any of us wants to undertake. So I'm really quite passionate on the importance of understanding things from first principles, which is why we're doing this session today. And if you are dubious about this, I take a moment and consider other complicated high-risk activities like getting into a silver tube and being launched 30,000 feet into the air. The pilot of this thing, he has had many years of training, but on his first day of training, he is taught the principles of flight. So the fact, the forward thrust generated by the engines overcomes the drag of the resistance of the air. The design of the wings of the aircraft, as air passes over them, generates more lift that overcome the weight of gravity. And the pilot understands this from a mathematical perspective in the calculus. And I don't think we would be that happy getting into this thing without knowing that the pilot could explain either in mathematical detail or very simply with a diagram like this as to why the vehicle we've got into does what it does. And I believe we should take the same approach to our trading if we're really serious about being good and professional and consistent and profitable traders. Yet what I see is that so many traders will pull up their charts. It might be a footprint, it might be a candlestick, it might be 5 minute, 15 minute, 4-tick reversal. I don't really care. But they'll pull this up, look for patterns they're familiar with, whether it's patterns in the volume or chart patterns or, God help us, magic price-based indicators, and they'll throw trades on. And they'll do this without any consideration of the context. Well, what's the context? It's zooming out, it's thinking about levels, it's thinking about structure. But they'll also do it with no premeditated plan or process for their trading or setups. And this is key to our development as traders. We need to find things that are provable and repeatable and consistent and give us a framework within which we can work. But crucially, they're doing this, they're pulling up their quick charts without a base level understanding of what is actually causing the price to move. Yet it's this movement of price which is what they're seeking to profit from. And this would be no different to us, getting into a plane and the pilot goes, well, hi, I'm new here, but, we're going to fly to Tokyo and I'm going to point this thing at Tokyo. And if I pull back on this big lever and press this button, we should get there. And none of us would want to do this. So let's consider ourselves as the pilot who is operating a plane, which is our trading account, and that plane is full of passengers that represent our equity. So we need to be as serious about our base level understanding as we can be. And we can apply this principle to how we go about learning things. We need to move forward through learning to have the fundamental knowledge that allows us to manage the bad habits we have and ultimately overcome them. And if we get it right, our profits rise. If we get it wrong, we blow up our account. That's at the highest level of learning, but the same thing applies to pretty much every element of knowledge that we want to understand. So today, I'll be talking about what causes price to move. But as we go deeper and more refined on these things, or as we develop trading processes, the same principle of understanding the cause and the effect of what's driving the decisions we make is, in my view, as a coach and as an educator, fundamental. And for me, it's the only way to learn and a good way to coach because you've got that base level knowledge upon which you can draw in the future. So, with that preaching over, let's consider who's doing what and why. I'm going to stick with this bit of pretty clip art and let's think about the CL futures market. Why do these markets exist? Well, financial futures, they came about as a way for producers to hedge or protect their future income based upon variability in supply and demand, and likewise consumers of commodities to do the same thing. So if we think about American Airlines as a large consumer of fuel, this plane holds nearly 50,000 gallons of fuel. American operate almost 7,000 flights a day and they've got almost 1,000 aircraft. So let's compare that to the size of futures contracts. A futures contract represents 42,000 gallons of fuel, 777's worth of fuel. Now, that's crude. It's actually 4,000 gallons of aviation fuel once it goes through a refinery process. So one aircraft is the equivalent of 6 CL contracts. If we do some rough maths on this, and I don't know if the assumptions I've made here on the fleet size and the activity of the fleet are right or wrong, But you can see that on a given month, the given month's consumption of fuel by American Airlines is like 85,000 futures contracts. I put that number up there not because it's that significant in terms of the CL daily volume. You know, Americans' consumption would be, say, 0.5% of the CL market. But it puts the 1 lot or the 5 lot or the 10 lots that we're trading in quite some perspective. And if American decide to enter the market to fix their pricing for March, and we're not reading it right, our 1 lot or 5 lot or 10 lot is going to run over really quickly. But of course, American aren't the only participants in the market for CL. There's 200 airlines worldwide. We've got oil producers, we've got state oil producers, Saudi Aramco. We've got oil companies that are kind of multi-tier in the supply chain. If you think about, Exxon, doing everything from extraction through to refinement, through to putting it in your car at the pump. So we as day traders are nothing individually in the scope of these markets. So we really need to be cognizant that the markets exist for the benefit of commercial users of the commodities that are being traded. And I use CL as the example because it's an easy market to relate to. We can all relate to oil. We drive cars, we get on planes, we heat our homes. You can do the same thing with, soybeans, pork bellies, whatever, but we probably, we don't all farm them. We might eat them, we don't farm them. If we think a little bit more in more abstract terms, though, think about, the equity indices and futures on those. Why do they exist? Well, commercial users are pension funds and insurance companies and investment companies. And the futures contracts are either providing an efficient way to get exposure to these markets or as a way of hedging other portfolios. When you think about bonds, it's a way for governments to deal with debt and for the participants in government debt to hedge their participation in that debt. Currency is similar. Gold is similar. Central banks will hedge against gold and things like that. So I always go back to oil because it's easy to relate to. But the principle that there are really big commercial users of these contracts holds true, whatever market we're in. So we need to be very aware of who is trading and why. So how can we track who is trading and what they're up to? And you are all for sure, familiar with the idea of a chart, whether it's a candlestick or a footprint, for those of you that use them. You're familiar with a dome, a depth of market, and I've got a depth of market display on the right, and it's showing the size that's available. So that's the buy and the sell columns. It's also showing the pulling and stacking, how it's changing over time. It's showing price, and then to the far right, it's also showing the volume that's traded, which is no different showing the volume that's traded in the footprint, but it's appearing in the dome. And if you think about the dome, it's an abbreviation for depth of market. Many people say they're dome traders, but are actually trading off the volume that's been traded, the columns on the far right, which is analogous to trading a footprint, but it happens to be a footprint that you're resetting when you choose to. Whereas a footprint is a representation of the volume that's traded, but divided up according to whatever chart period you're looking at, 5 minutes, 30 minutes, full tick reversal. But it's the same data. But let's think about, where this data is actually coming from. It's coming from the tape. So the record of what is happening when contracts trade. And that's this beige and blue box, which I've got at the bottom left. So there are elements from the tape which appear in the dome. If we look in the tape at the lower green box, we can see that trades have gone through on the ask. So we can see that the bottom row of the green box, one trade happened at the ask. When that happened, the size of the ask was 15. There were 15 contracts offered. But then the time the next trade occurred, the size of the ask was 22. So the ask was reduced by one contract, would have gone down to 14. But at the next millisecond, more contracts came into the market. We've got a whole queue of orders being added into the market and also taken away. That's the pulling and the stacking of bids and offers. How much stuff is being advertised for sale in the market is changing millisecond by millisecond. Now, our platforms update every 200 milliseconds, every 400 milliseconds. Let's say we've got an update 5 times per second on our platform. What we're seeing as data in the pulling and stacking columns, if we track that, it's only a snapshot based upon the aggregation of what's happened through the tape in those time slices. But, we're sampling at given points in time. The volume that's traded, so the 1, the 2, the 1 that we see in the volume column on the tape, that's represented in the footprint. Is how many trades were aggressively occurring as market orders, either buying, lifting the offer, or selling, hitting the bid. And we can see that across time slices using footprint charts, or we can see it on these histograms on the far right within the dome. And then at the top, where we're looking at the market depth, something that isn't apparent in the dome is where you see ask quantity 20, and you can see how that relates to the 55.84 price level. There are actually 13 orders there. So there's at least one order that is more than one contract of those 20. We're not seeing that in the dome. We're only seeing that 20 contracts are available. We don't know the constitution of those. Is it 12 orders of one lot and then one of 7? We're able to look in deeper, but we don't quite see that. All of these views are of the same raw data that is fundamentally visible through the tape and through the constitution of the order book, but how we represent it can vary based on our preferences or the capabilities of our platform. But unless we really understand where it's coming from at source, which is the tape, and the advertisements of what's available to buy and sell, we may lose sight of actually what's going on. So let's zoom in a little bit deeper to this and actually think about why price moves. And I'm going to zoom into a portion of this dome and the associated footprint near the current quote. So what we can see here, the current quote is 55.83 to 84. At 55.84, there are 20 contracts that are being offered into the market. We know that was through 13 orders. There are 20 contracts available to be bought right now. Likewise, there are 13 contracts that passive buyers are happy to buy. So 13 contracts worth can be sold aggressively and they'll be eaten up by the market. Very simply, what would cause price to move? Well, if somebody goes into the market and places a market order for 21 contracts at the current market price, which is going to be 84, all 20 of the contracts which are there in the order book are going to be eaten up, and assuming that no more volume comes into the market, the quote will move to 83.85 because the 20 that are offered at 84 will have gone. One of them that's being offered at 85 will be consumed, and that 54 we see at 85 will reduce down to 53 contracts. This, of course, is presuming there are no changes to the quantity that is offered to be purchased or sold, and it's just one single order that comes in for 21 contracts that hits the market. Markets don't move that slowly. Okay, ZB30 here does, but if we're watching CL, this is changing all the time. Same thing on ES. So our snapshot views give us a sense of what's going on, but the ebb and flow and the back and forth is happening at much higher frequency than what I've just talked through. The market order for 21 contracts goes and consumes the 20 that are being offered at 84 and one that's being offered at 85. We can see it in hindsight on the tape. We can see the volume that traded through the footprint or through the sales on the dome. We can also track how the quantity being added and removed from the market is changing over time. But very simply, what will cause price to move is that there's nothing left to be bought or sold at the current price. If somebody buys all 20 that are being offered at 84, then the market moves to 85. So another way of thinking about this is at the price we are at, when all the inventory is gone, nobody is prepared to offer stuff for sale at this price because the price is too cheap. So when 84 has gone, nobody in the limit order book is prepared to sell at 84. They're happy to sell at 85 but not at 84. Now, this is the first time I've actually brought some of the terminology in. Contracts are offered at a price. Likewise, on the buying side, passive buyers will bid a price for contracts. So the reason that price will move down, if all 13 contracts at 83 are consumed, we move down to 82 being the price at which people are happy to buy. Why is that? 83 is too expensive to buy, but buyers are happy to buy at 82. So let's be super clear on the mechanism of what's going on. We've got advertisements in the order book for quantities that traders are happy to buy or sell at a given price. But we need people to enter the market and actually respond to these advertisements in order for trade to occur. If there are no market orders, if no offers are lifted, if no bids are hit, no trade occurs. So the liquidity, the volume that's being advertised to be bought or to be sold, it only changes when somebody actually comes in and acts upon that advert. Now, a lot of the time, I get students who will say, but how do I know if what I'm seeing is an aggressive or a passive trader? And does the footprint show me the passive traders? And actually, it's all the same. Trade only occurs when an aggressive trade is reacting or responding to an offer that's there in the market. So what a footprint chart shows us is the history of the market orders over time. It's the same thing on the far right of this dome. We record the actions of aggressive market orders consuming liquidity. So the aggressive traders, the market orders, are the people that consume the liquidity. But liquidity has to be provided by passive traders in order for there to be a market. So although we see the trades and we record them as aggressors, market orders, who ate what was on offer, both people have participated in a trade. So it's wrong to be thinking about were these aggressive, were they passive? They were trades, but they were initiated, of course, by aggressive traders against the liquidity that was available being offered in the market. But let's think a bit further about this. If I'm American Airlines and I have an appetite for 85,000 contracts per month, how can I trade this? Well, if I want to fix my price for next month, I can't go in at market and place a market order for 85,000 contracts. Even if it's my daily volume of 5,000 contracts, I can't, if I place an order for 5,000 contracts right now, I'm not going to be paying 84. There are 20 contracts on offer, maybe there are more queued up behind or replenish, but I will strip out the whole market and move price in a direction that's not favorable to my activity. So commercial users who really need to trade volume in order to fulfill their commercial objectives, and for them, 1 tick, 2 ticks, 10 ticks is nothing. It's not even a rounding error. These guys have to work their orders into the market. So they will be using limit orders, they'll be using clever brokers and clever algorithms that are able to manage price up and down in order to fulfill their price objectives. But we should not assume that the people with real long-term interest in these commodities trade their big volume at market. It's just not feasible. There's not the liquidity available for somebody to go in at market and hit the market with an order of 5,000 contracts. So this is why it's important for us to be cognizant both of what's happening with aggressive orders that are consuming liquidity, but at the same time, what's happening when aggressive orders are consuming liquidity and how does that liquidity respond? And it's being able to interpret both of those things that allows us to become an effective trader that reads order flow. So the fact that there is nothing left to be bought or sold at the current price, and I'm referring to this because this is what moves price, what does it mean for us as traders? Well, if we're scalpers, if we are quite short term in our outlook, what we've got to be aware of is how the advertised volume, the liquidity, how this is changing. Is it increasing? Is it decreasing? But also how is it being consumed? We're looking at aggression, momentum, and we're looking to participate in these very short-term changes in momentum caused by aggression. Now, we don't necessarily do that on its own. We should have a playbook of setups and ideas, and we are maybe only trading at certain times of day or around certain levels. But if we are looking at very short-term initiative trades, then we're looking primarily at aggression and momentum. If we're taking more of a swing trade view, whether this is intraday swing or even multi-day swing, we need to be aware of both this aggression, but more importantly, we need to understand where the advertised liquidity, so the orders in the book, is unable to be consumed by aggressive orders. Supply and demand is not infinite. The capability of any buyer or seller to buy everything in the market, it just can't happen. But we know that if somebody is trading big volume for a strategic reason, they're going to defend that position, and American Airlines or JP Morgan or the Saudi Arabian Sovereign Wealth Fund has far more buying power than any hedge fund or you or I is really able to easily overcome. So we need to be aware where there are levels that are being defended because liquidity just keeps coming in. However much people try and buy it or sell it, people on the other side of that trade providing that liquidity are happy to keep providing more liquidity. We also need to be aware for swing trading of when the people that are consuming that liquidity realize they're wrong. Because what do? They get out of their positions. So as scalpers, we're looking very much at momentum, aggression, what's happening right now. As swing traders, we're kind of stepping back one layer and going, okay, what happens when we are at a level and why does it keep holding and what has been the pattern of volume that is trading through that? So that's the basic mechanic of why price moves, and that at a very high level is what we then start to interpret behind it. But without fundamental understanding, what can we do with it? Well, you saw from the view of a footprint and of the tape and of a dome, we've got the same raw data, but we can present it in 3 or 4 different ways. And the way that resonates most with you, it can be different from me, can be different from Jeff. We will all have a different way of being able to look at some of all this data and have it resonate well with us. It may be you want to see it on a candlestick chart, just with some summary data of aggressive buying and selling, called delta, underneath each candle. But once we're able to understand here are the components of the information we're looking at, and we've got some visual formats that make it clear for us, what we can then start to do to help our trading decisions is identify and act upon the successful or the unsuccessful actions of the aggressive traders, the people trading with market orders who are eating the liquidity. We can do the same thing. We can identify and act upon the successful or unsuccessful actions of the large traders that may be predominantly trading using their limit orders rather than entering the market aggressively. We can explore different views of the same data and see what additional information and decision support different views give us. We can start to understand why price moves to certain levels in kind of repeatable and understandable timeframes. We can look for certain patterns in the volume that's traded that can underpin certain trade setups that are repeatable, because we can analyze these patterns, understand what they mean, and track how they happen time and time again, and the propensity of price to move in a certain way based upon the patterns that we see. We can also, when thinking about price moves, consider how large bids and offers in the order book and liquidity can attract price and act as magnets. And we can also zoom out to longer term charts, daily charts, monthly charts, and analyze the volume patterns in here to see levels which are kind of hidden. You certainly won't see them on the candlestick chart, but without interpreting the volume, we may not see them at all. And then we can start to evaluate what tools can we use to do these jobs for us in the long term and superimpose them on the short term charts that we're using for our immediate decision making. Now, these are all themes which I'm going to come to in future presentations. I'm being very careful not to apply any phraseology to these. There are words like absorption, exhaustion, unfinished business, which can be classified, some of these things, but I'm not going to apply any of these phrases until I've delivered, here's the mechanic of what's going on, here's how it's occurring and why, here's what you can do with it, and then armed with that understanding, now we are entitled to give it a label of one word like exhaustion or absorption. So following today's session, these are going to be the themes which will continue over the next few weeks. But if there's one takeaway from today, just please remember that the basic reason why price moves, which is what we're all looking to capitalize upon, is there is simply nothing left to be bought or sold at the current price.
All right, thank you, Lee. And yeah, again, I just want to, number one, I want to thank you. And number two, I just want to say, I know there's people here that don't know some of the terminology that Lee was using. And to some extent, that's a little bit unavoidable, particularly in a short session like this. But I'm going to try to just kind of do it in third grade English for a few minutes and talk about some philosophy. And so my point of view, I started trading when I was 13, and I bought some stocks with some money I got for my birthday, and then got into options. And this is like in my 20s, so we're talking like the 1980s, and started trading futures shortly after that, the late 1980s, and started developing software in the futures market. And I had one of the first like trading rooms, I guess you could say, Dr. Jeff's Day Trade Clinic, and this is like in 1999. And one of the things that just became evident to me, as I kind of came back to seeing what was going on educationally and going on Twitter, is just that people are missing the process in so much of the trading world, and particularly people that are really serious about it. There's a lot of nonsense in this world too. And so that's what I'm going to talk about a bit. So Lee talked about this in what we call the microstructure, bids and asks and buyers and sellers lifting, prices up because there's no more inventory there. And the bottom line is financial markets are auctions. And that's what he's saying, just to net it out. And if you think about it, like, somebody's buying an exotic car, do I bid $1 million? Yeah. So we have $1 million. Do I hear $1,000,001? That's literally what's happening. That's the back and forth. And there's a lot of nonsense out there in the training world and the financial consultant world about making it a lot more complicated than that, and trying to make you think there are secrets, or that you really need to understand why something's happening. I get this a lot. Got this a lot in the workshop we just went through. People come in and God, the NQ, the NASDAQ just moved 100 points. Why? And the point is, it doesn't matter. There was more buyers than sellers, or more sellers than buyers. The reason isn't relevant, particularly in this kind of age of automation. And your opinion isn't relevant either. You think that Apple is worth $300, not $150 or whatever it's at these days. And again, your opinion isn't relevant. The only thing that's relevant is that collective opinion. And the example that Lee used was a really good one. If I'm in the oil market and I'm trying to catch the move from 59.90 to 50 to 60, that's 10 ticks. I mean, to the guy who's buying oil for American Airlines fleet, jet fuel for March to make sure he's got, all he needs, I'm not even a fly on the wall. I mean, I'm a gnat. So you really have to understand that you can't predict markets. You can't have an opinion about what's happening. You just have to understand what's actually going on. There's an auction, there's buyers and sellers. Whoever's being more aggressive is going to move the price. And so the only thing you really want to keep track of is that price volume action. And one other point I really want to drive home here is there's a lot of people that are very reliant on technical analysis, price levels, moving averages, take your pick, MACD, yada, yada, yada. There's hundreds of those things. Those are misleading for a lot of reasons. They are statistical results of what happened in the past, and they are not predictive. They can increase the odds you can predict something, but that's all. And so I like to refer to those as nonsense. Unless you can take that moving average and put it into the context of the auction right now, then it's meaningless information. And that's the problem people have in trading, and that's why so many people are not consistently profitable, and why so many people cannot just understand what's happening. It just always seems to go the opposite way of what they think will happen. And that's the point right there, is that they're thinking about what will happen. And none of us are smart enough to do that. So I want to just drive this point home. There's nothing magic about succeeding trading. There's no secret indicators or, guru furus on Twitter or newsletters. The bottom line is success is following a process, doing it with discipline and doing it day in and day out. And when you make mistakes with your process, you will fail. It's that simple. So what's needed to navigate this environment is a fixed process. And that's why we're using this process-driven approach to setup development terminology, because that's really accurate. That's exactly what it is. And I'm going to show you a couple of very quick examples of that. Your process has to take advantage of some edge, some advantage you have. A lot of ways to give you examples of that, but it's just probabilities, really. It's that simple. If you're playing poker and you get a pair of aces as your pocket cards in 7-card stud, or Hold'em, Texas Hold'em if you play poker, or if you're playing blackjack and you get dealt an ace and a king, you ought to know that's 21, you're going to win. That's what an edge is about. It's about knowing that the situation in the market and your approach to that situation right now is going to have the following odds of working, and if it works, you're going to make approximately how much money. That's what it's about. So in order to do that, you need a playbook of setups that execute against your abilities, whatever they are. I tend to be a pretty fast scalper, so mine head that way. But doesn't have to be. It could be over hours, days, months even. But market information, because of this auction nature, is much more accurate the shorter you go. And a lot of the conventional wisdom in the market is just wrong, but you hear it all the time. Oh, you got to zoom out to longer time frames. Yeah, you do, but the pure simple trends and the executable edges are often in the very fastest time frames, and then you can use that information in your longer term trades. So let me give you a couple of examples of that. The last thing I wanted to say is that you need a feedback system, because you can't back test this stuff. It's forward test. You got to do it live while it's happening, and you have to understand what you're doing right and wrong. So we call that finding your Bubba. I'm sorry, I banged my mouse the wrong way. And, I'm just playing on the movie a little bit, probably violating a copyright. But anyway, find your inspiration, find what works for you. And that's what we did in the workshop. And, there's a bunch of folks here that are from the workshop, and you see some of the feedback on Surfing the Markets. And I'm not telling you this to blow my horn. I'm telling you this that people are really finding tools and interactions with each other to get better at doing this. That's what we're about. So anyway, let me pop out of my PowerPoint here for just a second, and I've got just a couple of quick charts to show you. This was yesterday. This happened. So the NASDAQ opened way up, and it was like a fast ride up, and this was the top of the first hour right here, and I'm zoomed in on a really fast chart because we were a little bit above this, and we just kind of chopped around up here. But if you had looked at this in the context of the day, it was a huge move up, and so your natural instinct would be to kind of be long this market, to be buying it. But look what happened in reality there. Okay, so I'm going to zoom out just a little bit further here. This is a 3-minute chart. So what I was just doing was showing you this area right here. I was zoomed in real tight on that. Let me see if I can make this a little bigger. Anyway, I was zoomed in real tight here, and this was this big move up we had at the open, and this blue line is the first hour high. And this is one of those repeatable setups that we talk about in the group all the time. If you want to see what I'm talking about, just hop over to Surfing and Surfing the Markets. That's many of you come here from there. And just in the search box, just put in the abbreviation we use for that is FHH, first hour high. And you'll see conversation about this over months and examples and blah, blah, blah. So I don't want to beleaguer the point. I want you to see how predictive this can be. If you were looking at this from this trend up day point of view, you were probably trying to buy here, which was exactly the wrong thing to do, although it's easy to see why you would think that. And why was it the wrong thing to do? Because if you zoom in on the market structure, the microstructure of what was happening, this is that exact same area, it was actually getting sold. There was imbalances, as we call them, and Leah mentioned briefly, we're trying to stay away from terminology, but that's what's happening up here. It's buyer and seller imbalances. And the buying basically just got exhausted, and you could see that if you could get down to the granular detail and understand how to read it. So what was the result of that? The result was that. So this was that little area I was talking about. It looked like a long trend up. The trend traders were buying it. The smart traders that were reading the order flow were saying, gosh, this is a short with almost no risk. Because if it starts going back above the blue line, I'll get out of it. But I have nothing to lose, and I can even add into this trade. And it just kept working. In fact, it worked past the beginning or the bottom of that same range as low, the low of the first hour, which is another typically significant inflection point. You can see it ended up settling up down there in that area. So that's just one simple example of how getting this granular auction information can make your trade decision precise enough to take advantage of large moves, whether you're scalping them for a couple of ticks or points like I am, or you're looking to catch, the majority of the move over a couple of hours. So one more example, this is just, gold yesterday, and same thing, if you were in this as a trend trader as of this point right here, it was this massive move down on heavy volume. But then again, there are certain places that the market tells us that the auction sort of settles down, and one very typical place is that first hour. It's also called the initial balance or the opening range. And so you really need to be able to dig in there and see what's happening trade by trade to understand the enormity of the opportunities that you have. So that, in a nutshell, is kind of how you find your Bubba using this stuff we're talking about. And obviously, we're ridiculously oversimplifying, and that's a little unavoidable given that we have an hour, and you are on so many different levels of experience and education. Anywho, so just jumping back to this, what is important? A process so that you go through the cycle of evaluating that information, and then you reset yourself. You don't have bias, and then you do it again. And that's what we're talking about. You just do that over and over again. That's how you make money in markets. It's not about secrets. It's not about buying some indicator from some guy. It's not about being in a room listening to somebody broadcast what they're doing. We don't believe in any of that, and we don't do any of that, and don't have any plans to do any of that. Finding your Bubba is finding how this works for you, how you make the nonsense into sense for you. And I like to look at it this way. You can have a lot of knowledge about the markets, know what the futures are, know what the ask is, know what the bid is, know the different times of day that are active, understand that oil is a market that has little players like us trying to scalp and speculate, and big players that are, securing their fuel supplies, and blah, blah, blah. So, then you kind of build it into experience where you can see how the dots connect. But until you can truly interpret that auction experience creatively, you're not going to consistently make money. And that's how we're defining this this process-driven approach to set up research and development. And that's what I do in Surfing the Markets. And Lee has kind of come along, and through the workshop, we realized a lot of our stuff was synergistic. And the guys who are who came from the workshop and are in our group now, we call them the Motleys, a bunch of them are here. Look at the comments that they're making. This is a collective educational self-improvement venture, and everybody's digging it. So that's what we do. If you're intrigued, we will be sending further information on how you can join us. It's going to be very inexpensive. We're not looking to make a lot of money doing this. We're looking to all get better. And so I will invite you to try it out once we get it to the point where we can bring you on in, which is tomorrow-ish. So when the workshop concludes, I will have the recording. Lee and I will send that out to everybody that registered, and at that point, we will tell you how you can go forward if you're interested in working with us. Okay, with that, I'm going to open for Q&A. So give me a second here. I need to bring the chat up, and I can see the questions. So please type your questions in the box if you have any. Anything goes. Ask us anything. The topic is wide open right now. I have about another, the market's opening up in about 10 minutes. So, Lee, questions for Lee, questions for me. You have no idea what we're talking about. Something made sense, something didn't make sense. Please chime in. I will wait a minute to see if anybody has any. Oh, that's a very good one, Anita. Okay. All right. Excellent. Excellent. Two excellent questions. Okay. So in the fourth quarter, we had a workshop, Anita. And in fact, um, I am going to jump out of this. And basically, we have this Slack that has tons of material in it. This is it here. And there's literally 3 months of material in it. And what we're doing, to answer your question, is we are consolidating and moving a bunch of that material so it will make sense. We're adding a bunch of channels that are kind of building on that material. The people that were involved in the workshop are invited to join us as well. About 25 of them are involved already, and the interaction among them um, is not only do they get to ask us questions, but they talk to each other. And so the answer to your questions is it's a lot like a university. It's kind of like Lee and I are the professors, and there's a bunch of graduate students, and there's a bunch of freshmen coming in who have no idea what we're talking about. So they're sitting in the room just listening, and the people who've been around for the last quarter are, oh, I can answer that. I do. Here, let me show you. And people are meeting for coffee. I mean, it's really a cool interaction. And as we build it out, we're going to add more and more to answer that going forward. But I really want you to understand that there's a lot of it already because people are just naturally always at different levels. Software tools, Bruce, great question. Okay, the people primarily involved here are using one of two platforms, and we're going to pretty much focus on those. That's NinjaTrader and Sierra Chart. Lee is a Sierra Chart guy. I'm a NinjaTrader guy. We also use Jigsaw, which is a order flow day trading package. And there's some other plugins to Ninja that some people use. But again, we're not software specific. And we don't do software support. Lee sells some plugins and some order flow tools for Sierra Chart. He does some coaching and training in Sierra Chart. I do the same in Ninja. But what we really want to do is focus on, let me use this example. It's like we're carpenters, and there's a whole bunch of toolboxes out there. And I really don't care what tools you use. It's the concepts we're teaching. So, to see the bid and the ask, you can use OFA, you can use Bookmap, you can use whatever you want. It's the idea of how you integrate that, for example, with the first hour low, and then, how you choose to zoom in here and evaluate those footprints. That's your call. I'm just telling you, and Lee's telling you what we're looking at down there. So hopefully that makes sense. We're going to address the platforms. We're going to share templates and all that, but it's really up to you what software you use. It's such a personal preference thing. And one thing we are going to assume, we're going to assume you can run your own computer and you can, install your own software and whatnot. It's too difficult at this level. This is a professional level. It's too difficult to do Windows support and Mac support. And I'll just tell you right now, if you're not computer literate, it's extraordinarily hard to become a full-time trader. You have to be really computer literate to be good at this, at least at the, the operational level, using, Windows and Mac at a reasonably proficient, near expert level is the way to be. If you can code, that's better, but you don't have to. But you're up against professionals running a lot of money. Whenever people ask me questions about that, I love to bring this thing up. This is another surfing thing, but it's totally relevant. And it kind of puts again into perspective what Lee was saying about, how little we are. This thing right here, welcome to the hardest game in the world. You're up against people with more money than you. You're up against faster computers than you. You're up against better mathematicians than you. The only thing you can do is find a little unique edge and exploit it. And that's exactly what we're talking about. So, the tool that you choose to do that with is up to you. On Sierra Charts, okay, yeah, Lee, do you want to answer that one real quickly? I know that's an involved answer.
Yeah, sure, and I'm also happy to address Christian's question. On Sierra Charts, if you take their advanced package, they call it Package 5, it has a footprint built in. They call it numbers bars, but you pay your $35 a month, whatever, to Sierra Chart, you get footprints, simple as that. And to Christian's question, OFA, which I'm presuming he's referring to Don Raffaello's Order Flow Analytics. Order Flow Analytics is really adding indicators for a few platforms. I think he's got Ninja and I think MotiveWave now. What Don did was he came up with a kind of reversal bar. He called it probe and reverse, which some other platforms, certainly Sierra Chart can do. And then Don has got some proprietary algorithms that look for patterns in the order flow. Now I have a sense of what those patterns are. He's looking at aggression and imbalances and throwing jargon in here. But OFA itself is not showing you raw data. It's showing you a vendor's interpretation of some patterns. What we're about is helping you understand these patterns so that you can then understand what your chosen tools are using, or you can pick from tools that will help you do that analysis. So hopefully I've conveyed that subtlety well enough to make sense. If you have an OFA license, great. Even better, if you understand what OFA is doing in order to paint a rectangle, so you understand what it means and therefore you can act on it.
I want to jump in. That is such an important point that Lee just said right there. This is the carpenter tools thing. The skill that we all have and are teaching and are learning in return by teaching and interacting with each other is the skill of understanding market information, the data that the market's giving us. And some of us get on a really granular level that others of you'd say, my gosh, I just don't need to see tick by tick. It's the toolbox you choose to use, and you can do it on any level you want. The key is is understanding the structure underneath that. And again, we don't want to get into debates about different platforms and what they do and don't do. Yeah, my point is, it's what's under the covers that matters. And people love to get people are passionate about their platforms, and bless your heart, whatever works for you. You remember the Bubba thing? That's what this is about. This is exactly what that means. If your Bubba is whatever, some people use no software whatsoever. I know people that trade purely off price. So there you go. All right, other questions? Did we answer yours okay, Bruce? There's a lot of stuff there, but the basics to get started and the kind of trading we do would be NinjaTrader or Sierra Chart, and a couple of tools that you add to them. And you could do that with $1,000 or with correct me if I'm wrong here, about 180 bucks a month on the Sierra side. Is that correctly?
As a starting point, you could use Sierra at 35 bucks a month.
All right, there you go.
Footprint, you really have low investment.
Okay. And again, those are things, that we're going to have all that information available. And the people in the workshop for the last 4 months, we've been all exchanging that and perfecting which stuff we like and which we don't. And some people were migrating from Ninja 7 to Ninja 8, including me. And so there's a tremendous little collaborative gang we've formed here, and we want to grow it, but we want to grow it with people that are really on the same page. They're serious, here to make money. They're serious about finding the right tools, and they're looking for like-minded folks. And I want to lead that group, and Lee wants to lead that group, and that's what it's about. So anyway, we will send out some more information to everybody that was registered, to all of you and anybody listening to the recording. And check it out. It won't be expensive. We'll offer a little free trial. It will not be a trading room. We will not be making calls like, okay, gold's at 1559. I expect to see it at 1590, by tomorrow. That's what Furus do. Furus are fake gurus. They're all over Twitter. That's nonsense. And I encourage you to stay away from it regardless of what you do next, because, the place to invest is in your understanding of the auction structure of markets, whether it's from, with us or with Axia or any of the good programs around. There's a bunch of them. All right, thanks everybody for joining us. I hope this was useful, educational, and a little bit fun. We always look to do that as well. Thank you, Lee, and we'll all talk soon. Check your emails if you want to follow up with us. We will give you more stuff. Thank you, Dennis. Coming from you, that is a compliment. Dennis is an experienced trader, member of the Top Step and surfing groups as well. Thank you, Maria. Maria's a motley. She's one of our people that's in the crew, and we're having a lot of fun. Kevin just got funded at Top Step. So, there's a lot of success stories right here in the chat, guys. All right, have a good one. We'll talk soon.